All right, let's talk about the new NCR. This is Atleos. The ticker is NATL. It's just shy of a $3 billion market cap, and it was spun off from NCR in October 2023. This is the ATM side of that business. It's pretty cheap, and they've got a really solid outlook for earnings growth over the next few years. So it's a pretty interesting story. You can see the chart here. It's hanging around 25 or lower at the time it was spun off. Got as low as $20. Then traded in like a 25 to $30 range, was slowly drifting back to 27, 25, $27 or so. And then Altifox did a nice write up on it, and it's been rocking and rolling ever since. So it's almost $40, 2.9-ish billion market cap at that price. So I originally started, well, I looked at it at the time it was spun off about 2 years ago. And then it came back on my list because I saw this. It's screen cheap, right? It's screen cheap both on current earnings and on future earnings. And so I just read a transcript, and I saw this nugget here in one of the transcripts where the CEO is talking about cash flow and capital allocation. And he made this comment. Where is this in here? So okay, looking at free cash, right? He's talking. This is the 1Q 2025 call, right? He's saying looking at cash flow for next year is closer to 400 million, and for 2025 it's 250 to 300. And so based on the timing of their working capital, he's saying, hey, we've got $700 million of free cash flow coming in the next 6 quarters that he'll need to deploy. Right. And so he's commenting, okay, I'm not interested in a dividend, and leverage is getting close to where they want it to be. So a huge chunk of that's probably going to go back to shareholders in the form of buybacks. So at the time I read that, I was like, man, $700 million free cash over 6 quarters. And this thing was like a $2.5 billion company at the time. Like, dang. And 400 million is what he was talking about for next year. So 400 million on 73.6 million shares, that's north of $5 a share. And it was 27, now it's $40. That's still pretty cheap. So what's going on in this business? Well, they make, sell, service, and provide software for ATMs. I think they're the second largest installed base in the world. There's like 3 million ATMs deployed globally, and it's perceived as a shrinking market, right? And that global cash usage is declining. So it's got maybe a little bit of a melting ice cube bent on it. But what's interesting is that within that, there's this trend of banks trying to outsource as much as they can, lower their cost base, lower their upfront investment in this sort of stuff. And bank branches have been in decline for quite some time now. So they cater into that, right? And they've got an offering that they've pretty recently launched called ATM as a service, ATMaaS, right? It's good to have an offering with an acronym like that, where the banks can outsource their entire ATM purchase, maintenance, operations, like all the back office stuff that goes along with it. Actually, let's just pull up one of these slide decks. They've got a good here it is, the 23 investor presentation, which you should definitely look at if you're going to look at this thing. Here you can see the revenue mix, right? Hardware, software, services, and transactions. They've got a network of their own ATMs that they own. It was historically mostly a legacy, or mostly a hardware centric business model. Now it's mostly recurring revenue, and that's where they're headed. Here's cash usage. These are estimates. And then here's stable installed base. This is missing a bunch of units, so I think they're excluding a couple of countries from that. Okay, ATM as a service. Let's talk about ATM as a service. I think that's really the big reason to get interested here. So historically, NCR was targeting the hardware, the software, and sort of the field services, as they call it. But there was this world of other stuff that the banks had to do that now they can shed to a company like Atleos, and peers are starting to get into this as well. And so this offers NCR a 2.5x revenue opportunity compared to what they were doing historically, right? So this is the old model. right? Here's the upfront hardware. Here's the small tag-in piece that goes with it, the service contract. And then under the full ATM as a service, right, they get a little less upfront because the hardware is baked into that. But the life of that contract is significantly larger from a revenue and gross profit standpoint. So this is the big theme. This is the big theme. And what I like about it is, oh, it's in here somewhere. You know what? Let's just go to the write-up because I know I took that picture. Okay. We'll get to that. We'll get to all that stuff. Here we go. This is what's interesting. So if they've got a 600,000 ATM installed base as of 2023, and you can see here's the ATM as a service component within that. If they're looking out into the future, 2027, assuming no change in the install base, so no market share gains baked in, if they can convert their existing customer base over to this ATM as a service offering, that is the core thesis to them achieving their 2027 targets. And this is very much like they're 1.5 years into a 3 or 4 year target plan kind of story, right? That's what's going on here. So I like this. I like this idea of, hey, we've got this significantly more profitable and revenue generator offering within the portfolio that we don't need heroic assumptions in the rest of the business. That's pretty fascinating to me. And you can see, if you just go pull the last 3 or 4 earnings presentations, they're gaining traction in this thing. Like, it's small. It's like 6% of total revenue today, but ATM as a service, it just grew 32% year over year in the latest quarter. And the previous one grew 24%. And the quarter before that grew 24%, right? So this thing is growing. It's now 250 million ARR business, super sticky. You can see the gross profit is expanding at a faster pace than revenue. So it's definitely gaining momentum, right? And then here you can see the revenue and gross profit economics of that ATM as a service. So that's it. That's the core, right? So within the ATM industry, you have this perhaps secular decline over a long time period, and yeah, there's some emerging versus developed market differences, but within that, you've got this ATM as a service that caters nicely into this trend of banks wanting to outsource different components of their P&L, especially on the smaller end of the spectrum. So there's 2 segments here: self-service banking, and then network. So I'll talk about network real quick. They bought Cardtronics, which has this all-point network. You can see it in their slide deck. They own a whole bunch of ATMs, and they've got a network of partner ATMs where you can go and you can use your debit card without having fees, and banks participate in this, right? So that's one piece of the business. And there it is. The long-term plan here is grow this business through transaction volume, right? And this is mixed bag, right? Q2, hang on, let's get Q. As of Q2, I don't think it's quite playing out that way. Here it is, Q2 earnings presentation. So I think this business is, here it is, right? So revenue is kind of punky, and EBITDA is punkier, right? So it's not quite playing out to that. So we'll have to see what comes of that. So that's the network segment, and that's, call it 1.3 billion of a 4.2 to 4.3 billion revenue company. So really the big driver here is this self-service banking. That's the ATM software, the services, and ATM as a service lives within this segment. And so you can see, when they laid out their investor day, much of the growth is embedded in this ATM as a service offering, right? So that is the key driver really over the next few years in this name. Okay. Peer group, they've put some good charts out on, here's the differences between the peer groups. They each do a little bit of a different thing, right? Diebold's mostly hardware. They still have their retail business, which NCR spun off into Voyix. Brinks is a pretty different business, but they also have a managed services component to it. And then Euronet is mostly a money transfer business, but they have some ATM stuff within there as well. And that peer group is trading at like 6 to 7 to 8x EBITDA, and 9x earnings for Atleos and Euronet, and 13 to 14 times earnings for Brinks and Diebold. So kind of an interesting mix. Uh, Whether NCR is worth that, we'll come back to that in a moment. Let's take a look at the long run fundamental trends of the business. 2022, they bought Cardtronics. That was a $2.5 billion deal. You can see the EBITDA margin expansion. This is the 2025 guide, and this is their 2027 target projection, right? $5.5 billion in revenue, almost $1.4 billion of EBITDA, 25% margins, $500 million free cash. So this thing is going to look really, really different if they wind up achieving these targets that they set out during that investor day. And based on the 2025 guide, they're not too far off, right? So 3 to 6% revenue growth, 7 to 10% EBITDA growth. Those are both constant currency. And then earnings growing 21 to 27%. Free cash flow hitting 260 to 300. So they're making progress. And really, these are all pretty reasonable assumptions. Let's just pull up the K and the Q, right? Like I had the same thought. I said, okay, well, how are they growing earnings that much? How are they doing it? They've done an excellent job of cost management as a starting point. So let's go to this. Let's get rid of this. Oh, come on. Where is it? Financial statements, P&L. They've done a great job of managing costs. So here's your SG&A, right? And they spun off in 2023. So these aren't really totally fair numbers, but 585 down to 518 million SG&A. And then as of Q2, right, you've got SG&A continuing to fall. So excellent cost containment there. We already know the ATM as a service thing is growing and adding additional gross profit. And then the other big piece is interest, right? So here's interest expense. So 69 million down from 79 million. So, if I take that run rate, of 69 million, there, let's pull my handy dandy calculator. 69 million times 4, 276. Well, 2024 was 309, right? So interest expense coming down, SG&A getting nice leverage, ATM as a service is growing. Those are the key components that are adding to that 20% plus EPS growth. Then if you start to layer some buybacks on top of that, it really makes sense that they could get to 20 to 30% EPS growth for the foreseeable future. And maybe that installed base that they're projecting for 2027, that might even be low, 125,000 units out of 600K in their installed base. Like, hey, maybe there's more room behind that. So if you take earnings at the $4 a share they're guiding to 2025 at $39, it's trading right around 10 times earnings. If you use the 13 to 14x multiple for Brinks and Diebold, maybe you get to 50 to 60 a share. If you keep growing those earnings in 2026 and 2027, use that same multiple, 60 to 70 bucks a share. Do they deserve that? I don't know, but they're saying, hey, leverage is going to cross below 3x by Q3, right? So check that box. They just announced a $200 million buyback. So, that's 7% of the market cap. So, now they're starting to get some flexibility in how they spend cash on top of it. So I don't know, it feels pretty early innings. It's a really pretty interesting idea. I linked the Ultifox presentation in here so you can take a look at that, right? It's pretty good stuff. So I think the things that I would want to know still, right? I don't own shares of this yet, but I find it really fascinating, and I like that it's a big earnings grower trading at a super cheap multiple. But other people can offer this, right? I mean, I don't think this is something unique to them. In fact, I was looking at the Diebold investor presentation. Let's just pull this up real quick. To 2025 presentation. So Diebold, I don't know if they have got a managed services offering. I haven't dug deep enough into this stock since they came out of bankruptcy. But they have, it's not in this deck. Here it is. Okay. They have an investor presentation where they're laying out significant growth over a 3-year time period, right? So revenue not growing too much, slow and steady, free cash flow for them exploding from 109 million in 2024 to 330 to 360 million in 2027. So they're kind of predicting the same thing that Atleos is talking about. So I want to know what makes the ATM AAS offering unique to Atleos versus peers, because they're also ATM experts with large installed bases. And then the other thing is, does the bank consolidation thesis, does that help or hurt this business model? Right? If small businesses get gobbled up by larger businesses, does that help NCR accomplish this? So I don't own shares yet, but this one is really, really pretty fascinating, mostly because they're already making such great progress. And the growth is pretty, it's right in front of you. So, I mean, it's pretty obvious that they're gaining some traction in that managed services offering. So check it out, valuedon'tlie.com. This is, I don't know, quick value 280, quick value 280. And drop a comment, because I'd love to know if anyone else is looking at this thing or what they think about the long-term thesis and the melting ice cube aspect. Thanks.